All right, everybody, welcome to the Sunday edition of This Week in Startups, the show that never leaves you hanging over the weekend.
And Molly has a great question for me for VC Sunday School. She had a friend who wouldn't invest in first-time founders. They like to have seasoned founders. And she asked me this very important question about, hey, is that a thing? Should you only invest in second, third-time founders or first-time founders? It led to a wonderful discussion that's very candid and that most VCs will not have publicly.
That's exactly the beauty of this show. And then, because in the news right now is this inflation reduction bill that nobody saw coming, Joe Manchin surprised the world by signing on to a bill that includes $369 billion for climate. I called my good friend Jay Coe of the Lightsmith group to say, hey, that seems like it's going to be good for us climate tech investors, right?
Yeah.
And we had a nice, newsy conversation about that.
This is exactly the discussion I've been waiting to hear because I've been trying to take apart this bill. And congratulations to President Manchin on getting this through, getting this to the finish line, or apparently close to the finish line.
We hope.
It feels like it's getting there.
Hopefully, Vice President Sinema won't screw it up for all of us. But
yeah. Well, she might also save us on the carried interest. So.
She probably will. We talk about that too. We talk about the built-in sacrifice.
I like it. It's no sacrifice for me.
Listen,
or you, Molly.
Win-win for me. Win-win.
It's a win-win for you. Molly, you're winning so much.
I mean, right? This is a great year.
But we break down the important work in this bill to give credits for EVs and how that works and how that stimulates the adoption of these great technologies. And Molly and I obviously have strong feelings about this. It's going to be a great show.
Stick with us.
This Week in Startups is brought to you by OpenPhone. As a startup founder, a lot of mistakes are easy to roll back, but using your personal cell phone number as your company number isn't one of them. OpenPhone makes it easy to get business phone numbers for you and your team right on top of your existing devices. Visit openphone.com/twist to get 20% off your first 6 months. MasterClass. Learn from the world's best minds, anytime, anywhere, and at your own pace. Get 15% off an annual membership to MasterClass at masterclass.com/startups. And Odoo is a fully customizable and fully integrated suite of business apps that lets you build and scale your stack as you build and scale your business. Your first app is free forever, and right now Odoo is offering $1,000 off your first implementation pack at odoo.com/twist. That's odoo.com/twist.
All right, everybody, it is Sunday. It's time for me to get my learning on. VC Sunday School.
What's on your mind?
So this was super interesting. I was talking to a friend, connecting, who is an angel and a scout, and so we were comparing notes. Who do you want to talk to? Doing that like networking thing, and he made this really interesting comment. Like, he was talking about his kind of filters, and he said that a filter of his as a former founder is that he never invests in first-time founders, because he says he was one. And he thought he was too stupid to make it work. And so now he just really optimizes as an angel for founders with some experience. And we have some stats on this. Like, apparently, according to a Harvard Business School study, first-time entrepreneurs have an only 18% chance of succeeding, whereas entrepreneurs who previously failed have a 20% chance of succeeding, which doesn't seem that different, I guess, 18 to 20. Yep. Feels like statistically insignificant, potentially, but maybe not. And then a VC-backed entrepreneur who starts a company that goes public has a 30% chance of succeeding in their next venture. So I just wondered what you thought. What do you think?
So this comes up a lot.
Yeah.
There are a lot of biases, and one of them is survivorship biases, right? And when people see Zuckerberg and Gates and Steve Jobs knock it out of their park with the first company, they assume first-time founders, because we have these outrageous examples, are what you should bet in. And the thinking there, again, this is people with confirmation bias saying, okay, we saw this, what was it? Oh, they have a fresh mind. They don't know how hard it's going to be. They have a disruptive worldview, whatever it is. They come up with all these reasons to explain the success. What they don't see is the other 10,000 companies that had no success, modest success for every Bill Gates.
Right.
And so the truth is, after each successive failure, I would say you get 50% better at running a company at the very least.
Yeah.
At the very least. And this makes a ton of sense. Now, the problem is, if you've done a company in your 20s, then you do one in your 30s, and now you're in your 40s, maybe you got one more in you, but you got kids, you got a family, you got a mortgage, you don't have the energy level, you get more tired.
Also, you know what you're in for, and so you feel you dread it / pull back on certain parts of it that you know are going to be really hard, as opposed to when you're young and dumb and strong.
Exactly. So the young and dumb and strong and energy, again, this is age bias, I understand, is what most investors would say behind closed doors. Now, but the truth is, you get kind of like old man, old lady strength, a different, you get mama strength, you get, dad strength.
You become a master multitasker.
Yeah. So this is like a different level of sophistication, which is, you're not good at something. You don't want to do something. So you just hire somebody amazing. You know how to lead people. You know how to hire people. You know when to sell. Mm-hmm. And you may not have that cutthroat insanity of youth and that just never-ending supply of energy, but you also don't have the spastic nature of young people. Now, also young people maybe will bend the rules a little more. They'll not be like, oh, there's copyright law. Oh, there's Airbnb, Uber, local regulations, Coinbase, Theranos. You can make a long list of people who have just, not really paid attention to that. But the truth is, the optimal age is probably somewhere in the 30s into your 40s, because you still have energy, but you got some experience. That's what most people believe. So I'm putting aside my thoughts on it. I'm telling you what the industry has experienced and what people say behind closed doors, which is kind of what this segment is about. Totally fine to invest in first-time founders. You may, if you lose, you were their first backer, so they may come back to you for the next one. Now, remember, Travis, Uber was his third. I had interviewed him when he did Scour. We had been friends when he was doing Red Swoosh, and on the margins, we had hung out and jammed on different ideas and talked about stuff. And so my relationship with him for the third led to that. I was an investor in Rapportive, and then his second company, Raul's, was Superhuman, right? So the first company sold for maybe 20, 30 million. Superhuman's worth a lot more than that. I won't say exactly what the valuation is because I'm not sure if it's public. But I secured my position in Superhuman by, I think, being one of his best investors in Rapportive. So there is that benefit of backing a first-time founder.
Right. Is that you build a relationship, and if you think that founder is great, even if their first company is a dog, their second one might be great, and you still want to know them.
Yes. And there was a study, again, back to Harvard Business Review, HBR, which does a great job, by the way. They had done some research, and they found the average age at which a successful founder started the company was 45. This is what it's about. If you look at somebody like Mark Pincus, he had started a bunch of different companies and then just continued to have great success into his 40s or 50s. Elon falls into this category. Tesla came after Zip2 and PayPal, right? And PayPal was obviously a unicorn too, so it's very successful. So you just have a greater chance. And then also what happens is there is a personality consideration here. Some people love working with young founders. Other people find them annoying. And they don't want to deal with people who don't know how to run a board meeting or don't know how to hire people. And they don't want to mentor. Sachs started Yammer when he was 58, 10 years ago. I'm sorry, 38. He just looks 58. He's not that old. He's younger than I am, in fact. Which is crazy when you think about it. I look so spry and young, and would you ever guess Sachs is younger than me by a year? Crazy, right? Weird. It's kind of crazy. It's that hard Republican living.
You should stop now. It's clearly aging to become a billionaire.
It is. It's the GOP lifestyle. You know what
it
is?
It is that GOP lifestyle, yeah.
It is. It's kind of like dark crystal.
You're just so filled with hate.
You absorb that dark crystal energy. I was about to say it's like the Skeksis.
The Skeksis.
Yeah. So anyway, that's as much as I can tell you about this topic.
Well, it sounds like what you're saying is like, don't worry about it, right?
Don't worry about it.
That we do. There are some metrics that could guide you, but it sounds like what you're really saying is like, there's no reason to have that. If you're an angel and it's your money and you are trying to be as like, and I'm not saying we're not trying to return the most we possibly
You
can.
want to reduce downside.
But you want to reduce downside. And so you could imagine that if you were trying to reduce downside, that might be a useful filter.
Of course. So what your friend is probably doing is they want to have a simple life. They probably want to invest in serial founders because they don't want zeros. And they don't want people calling them when they run out of money. They just don't want to deal with the shenanigans of youth, the folly of youth. I kind of like the folly of youth. I like hanging out with young people. It keeps me young. I tell people I'm 51. They're like, no. And I'm like, well, I hang out with a bunch of kids. And they're like, oh, is that why you act like a child? I'm like, sometimes, yeah.
It's just personality. It's more fun.
Or it's personality. I just, I don't want to grow up. And so I do think if you wanted to reduce the number of zeros in your portfolio, I talk about this at Angel University, which has raised over $200,000 for charities, angel.university, to see the list of charities that we've donated to. That course I teach, I tell people, hey, for your first 20 investments, invest as little as you can, 1, 2, 3, 4, 5K per deal, if you're an accredited investor, and invest in companies that already have their products in market with 10 customers. You've got diversification, you're diversified. And number 2, you're not betting on product market fit. You're betting on going from product market fit to strong product market fit and scaling an organization. So you just eliminate a lot of zeros. So I like zeros because I know how much I can lose. Like in the accelerator, we lose 100K, we lose 100K. Okay, I'm okay with that. Let's take a lot of chances. Now, if it was $1 million each bet, okay, wait a second. We got to really think this through. So bet sizing matters. This is why in poker, which we got to start a poker game for folks who folks who want to learn. In a poker game, if nobody raises before the flop, and you've got any 2 cards, and you're in position, and you can pay, if you're playing $1, $2, and it costs you $2 to see a flop, why wouldn't you see it? It doesn't cost you a lot. Now, if it's raised to $20 or $50, you're like, well, I don't think these are really good cards. I think I'm behind. I'll wait for better cards. I can muck these cards and wait for better ones. So, that's what you're trying to do here is wait for a good hand that you can make a good bet on. And we see this now in our organization because we have so much inbound. We were calculating it on Tuesday's investment call. I gave people the idea of the funnel. It's like, well, we're kind of sorting through 15,000 companies and meeting with, this many thousand companies to make, 100 bets. And, it's less than 1% we bet on, and that's really the more companies you can meet with, the more you can qualify, the more you can check in on, you're going to be selecting from the best of great options. And that's really what you want to do.
Yeah.
You want to be picking from, 10 really great opportunities this week to make an investment, not picking, the best of 10 okay opportunities. Really, that's why process matters so much. That's why you and I are talking every Sunday on VC Sunday School about the process of becoming a world-class investor. And I'm learning that in the public markets now, and people get to see me with J Trading, learn that process. It really is about thinking. Your cognitive biases, all of these different modalities of thinking, building the architecture and a framework for the company and the model, the business model, the market, the founders. When you can construct that in your head and you've got in your head, hey, serial founder, great, they're not going to make as many mistakes. Oh, but they're going after a tiny market, or they're going after a vanity virtue signaling play. Oh, okay. You start to build these models. Oh, there's a young founder, but look at the execution. Oh, they have great energy. Oh, they've made a couple of mistakes. Oh, they learned from the mistakes. And so that's what I look for in young founders, just to wrap up here. When I work with a young founder, coachability and ability to ask great questions and listen. Some of the most extraordinary founders I've met will ask me questions constantly. And I'm amazed by them taking notes and their follow-up questions. It's like talking to a great journalist or a great interviewer. I'm like, well, this person really wants to learn. They're asking me a series of questions and they're writing down the answers. And then they're asking me who else they can talk to about the same topic. Okay, they're collecting a lot of information because they haven't made this decision. And a founder who doesn't, that's where I get concerned. I've had founders who are like, they just unilaterally make a decision to do something and it turns out it's risky. I'm like, well, do you want to talk to somebody?
I was right here, man.
Well, not even me. Sometimes I like to play it humble. Like I learned having Roelof Botha on my board from Sequoia. He would ask me probing questions, but he would kind of lay back and say, oh, do you want to talk to somebody about this topic? We might know somebody in our portfolio or on our team who's actually addressed that issue. When I had crazy ideas of things I wanted to do in my youth. And so I think that's one of the things I like to look for is with a young founder. On the program today is Darina Kulya. She is the founder of OpenPhone. Welcome to the show, Darina.
Thank you so much, Jason. Great to be here.
Now, what mistakes do most founders make with phone numbers in their startups?
Really delegation, right? Because what ends up happening is that as a founder, when you're starting, you do everything. You're the salesperson, the support person,
You make the coffee, you do HR, marketing, sales, recruiting, everything.
Yeah. But then eventually you have people joining the team. And what ends up happening is if as a founder, your phone number, let's forget about the privacy, the spam, all that problem. Let's say it doesn't exist. But you're not going to want a year into your company, 2 years into your company to have all the support calls or all the questions come to you, because now you've just hired your support team. Why did you hire them?
Yep.
So that's another reason why having that separate number makes so much sense, because you can always delegate those calls to your team as you grow.
All right, everybody, here's your CTA, the old call to action. Twist listeners, 20% off any plan for your first 6 months. Just sign up at openphone.com/twist. And if you got an existing number, no problem. They'll port it right over. openphone.com/twist, openphone.com/twist today for 20% off.
It's not necessarily disqualifying to be a first-time founder. There are probably, it's not, and it's interesting. It just clearly is like, it's about looking for those other signals that suggest that this person may be a first-time founder, but they're also a really, competent executor, very technical, whatever it is on top of that. And then also, depending on your personal circumstance, we have the power law on our side. So more failures could be tolerated. If you're an angel, it sounds like it's just a different calculation in some ways. See, now we're getting into like not just rules, but the subtleties.
There's a lot of subtlety here.
The strata.
And a lot of people have different strategies for winning. Multiple strategies can win. In the stock market, I'm learning, some people like to buy options and puts, and some people like to short stocks. Some people like to trade stocks daily. Some people like to hold them for just over a year and, make their decisions so they hit short-term capital gains and are taking taxes into account. Other people like to buy and hold. Some people like to buy index funds. All of these people can have different levels of return for different levels of effort.
Yep.
Right?
Yep.
What I'm trying to do is just really understand all of those, as many of those as we can. If you really understand investing and what you're doing in investing is, you're finding a team that's building a product, and then that product this is why I always focus on team, product, customer, TPC. The team, the product, the customer. That will never change in my mind. And you're always going to have that discussion no matter what company, under what circumstances we're talking about. We're talking about, Warner Brothers and HBO this week in Startups, and we were talking about Amazon the week before, and Disney the week before that when we were making J-Trade, talking about Stitch Fix. Okay, tell me about the team. Oh, it's Zaslav? Okay. Really good. Oh, tell me about the product. Oh, HBO Max, kind of kicking ass. Tell me about the customers. People like to pay for streaming. Okay, great. I'm building this model.
Yep. Win.
Yeah, and you don't really have to overthink those three things. These three things, you can believe what you're experiencing. That's what I like about them, because a lot of the people I meet they're drawing lines on a chart, or they're building, models or projections, and I'm kind of like, well, this is in the ether, it's abstract, it's okay, great, I guess it's valuable, but the product and the customers and the team, like, that's real reality for me.
Yeah.
And that's what I just keep leaning into. And the public market now is making me think about that even more. Okay, there's a new CEO at Disney, there's a new CEO at Amazon. What decisions are they making? Oh, there's a new person running HBO. What decisions are they making? What have they done in their careers? Oh, this person ran parks. Oh, this person grew Discovery into a juggernaut. Oh, this person was, Bezos's right hand. Okay. I'm starting to feel confident in those leaders, wartime CEOs, perhaps in some cases, cutthroat, not afraid to make hard decisions. So then when you're meeting entrepreneurs, when you're meeting a young entrepreneur, what do you,
hard to
tell, right? So you're getting this unbounded energy. You're really squinting. Like when you meet a 15-year-old or something and you're like, I wonder what this person's going to be like as an adult, and we all do that with our kids, right? Like,
Yeah.
Oh yeah, it's 12. Are they going to be a fashion designer or the president of the United States, or are they going to be a barista? Or
Give me the Snapchat filter that shows what you're going to look like as a future founder.
Exactly. So I love this question. I love this observation. I think it leads to a really good discussion. And the truth is, you're going to see great success from both groups, but you'll contend with different things in the investment. And ultimately what we do as capital allocators is we're finding the best companies we can, and then we're placing a bet on them. And you can't lose sight of that, because you're placing that bet at a certain valuation to get a certain return. You could find a company you love at too high of a valuation. There's no chance for a return. You could find a company that you have, concerns about, you're kind of in the middle, but it's a great price and they're starting to execute. It might be a good bet to see, if they actually, it's a long shot, but if it does hit, it could be great and you got in at the right price. So maybe it's a risk worth taking, right? And you have to just evaluate each one of those, but never forget it's an investment. And that's the problem. We're sitting here talking about personalities, Molly.
Right.
We're talking about who is this person and what are they going to be when they grow up, and what have they done if it's a seasoned entrepreneur. And don't forget, it's a bet. It's a financial bet.
Yep.
Made in comparison to other opportunities you have, or the ability to not place a bet this week. Right? There's no gun to your head that says we have to make a bet this week. If we have no bets this month and we make twice as many bets next month, we're okay with that. We're not in a rush here. Let's find the great opportunities, because these things take 10 years. Man, I can tell you, I've had 2 or 3 instances where I made bets on the wrong people, and it didn't take years off my life, but it was weeks months
time.
of sucking my time, which is all we have at the end of the day.
Yeah.
Great episode, I think.
Well, speaking of investment, on This Week in Climate Startups, actually, I've got a great investor, just long time. I've been interviewing this guy forever, Jay Koh, who is the co-founder and managing director of the Lightsmith Group, which is an investment firm that focuses specifically, maybe the first to focus specifically on adaptation and resilience. But we're on the news on This Week in Climate Startups because he works with the UN also. And so he came on to break down the details of the Inflation Reduction Act. The parts of it that would be a huge tailwind for climate investing should it pass. So it's like,
I really want to hear this.
Tactical, he's just a really, really knowledgeable guy. He has all the numbers. And again, it's like when you combine, like, private industry can get a lot done, no doubt about it. But if you get a big policy safety net and the government has a huge buyer behind you and incentives, it's like tailwind galore for this investment category.
I was delighted to see in Fight Inflation Act, which seems like the wrong name. I don't know why they name these things the opposite of what they are. This is an Energy Climate Act, right? This is mostly climate?
It's a lot of climate. It's $369 billion worth of climate. Yeah.
Okay, so maybe it's not mostly. But it's a big chunk of climate.
But it's huge. It would be the single largest investment the U.S. has ever made in climate.
Yes, which is great. And I really liked, I know Freeberg was like, let the free market decide on all in last week. I disagreed with him.
Yeah.
I like these subsidies specifically for EVs.
Yeah.
You guys did talk about that, I assume.
I asked him specifically. I was like, what about this idea from some people that we don't need any government intervention and it just perverts the incentives?
Yeah.
Yeah.
Interesting. I want to hear that answer.
The truth is, like, no, it not only does it create stability, but Jay makes the point that, it's government's role. A big part of what this does is make sure that these solutions are available to people who are disadvantaged, who are feeling the effects of climate. Specifically, private, that's not our job, right? But that is the job of government, is to help the people who need the help the most.
Absolutely.
Because our solutions are going to start expensive and get cheaper over time.
And what I was delighted to see was, you and I are not getting the $7,500 credit for our cars because we make too much money. You have to make under, I hate to reveal your salary, but you have to make under $100,000 or $75,000, I think, to qualify for this $7,500. So if you're making more than $100,000 in your household, I don't think you qualify for this, which is great. I don't want to qualify for it. When I got my EV credits previously, I think I collected them in 2 out of 3 times or whatever. And one time I was just like, whatever, I'm not going to feel out the paperwork for $2,500. But I really liked the fact that, hey, it's not for $150,000 supercars. It's only, I think it was $75,000 or cheaper. and you had to make under 100,000 in your household. So this is going after the middle class or below in terms of maybe giving them a chance to buy an EV.
And to make these solutions that are so valuable, affordable to people. Jay also made the point that, we have somebody in the chat saying it's the government picking winners and losers when Tesla is clearly the winner. He made the point that the last time we made a climate investment that was a fraction of this size, $500 million of that money went to Tesla.
Exactly. Yes,
so that's what I forgot. How it gets started.
If they hadn't done those, because there was Solyndra, I think was the big dog in that. I think Fisker and Solyndra, they lost all this money. But the 500 did go to Tesla. This was Obama's, bet on energy.
Yeah,
and Tesla paid it back early with interest.
Yep.
So again, if it's loans,
no, it's not a knock on Tesla. It is a good.
It was great for Tesla.
That kickstarted something that created an EV market in America. That's what government investment can do when it's done well.
So what can this do? This can push down. Hey, not everybody can afford a Plaid Model S. Not everybody can afford a Model Y for $70K. Or a Model 3 for $50K. But now, hey, if these $50 to $75K cars can be $7,500 cheaper and 10% or 15% cheaper, hey, that could be the difference, right? That could push some people to give it a shot, right? It could get some people into some showrooms, and that's what we want. And if it makes, because now we have Lucid and Rivian and
Polestar.
BMW. Which one did you get?
Polestar.
Polestar. You get all these, what did the Polestar go for? Was it under 75 or over 75?
It's just under, yeah. I think you could get it up to 75, but 60-ish. Like there are a lot of them sit in that 50 to 60 range right now, which is not that affordable for a long range, right? For people. The Bolt is more affordable, but you're going to start to, again, this is how prices come down. And this is how prices come down for solar and batteries and all the things that actually make the grid operable when it gets super freaking hot, like now. Like it's a game changer if it passes.
I also think that they're presenting these things. They don't do a great job with the marketing and PR on these things. The other thing you can think about this is energy independence. Yeah. And so we do need to take into account energy independence and climate. And if you look at energy independence, do we really want, countries to be dependent on Russia, Venezuela, Saudi Arabia, whatever country it is that has oil?
Afghanistan for lithium. I mean, it's not even just oil, right? Like, yes, it's energy independence, but we need to be extracting lithium. We fully freaking do. And other rare earths, and all of those opportunities are available to us. And energy independence is a huge part of this. And grid resiliency, like creating an energy system that can work. Yeah, look at Texas.
Texas keeps going down. I mean, Texas, it's, I was thinking about moving to Austin. I looked at the monthly chart. It was over 100 degrees every day this month. I was like, 108 degrees? I've got to rethink this Austin plan.
And it is just going to keep going up. Like, we've got natural air conditioning right out the window, bro.
Exactly.
Big old bay.
Cannot wait for this. Great job, by the way. These climate interviews are just really piling up, and it's really becoming a nice collection. It's really well done.
It's great.
Done. Listen, MasterClass is the best way to learn from world-class instructors at the top of their fields. I love this product. We use it in our household. We've got a yearly subscription, and their amazing courses include my guy, Steph Curry, teaching shooting and ball handling, legendary and former Disney CEO Bob Iger teaching you about business leadership and strategy. That's a great course. I've watched it. And I recently watched Chris Voss, a former FBI lead hostage negotiator, teach the art of negotiation. Now, you may have read his book, you may have done the audiobook, whatever. Those are great. I love Chris Voss. I've heard him be interviewed on podcasts, but when he sits down and does a masterclass, that is the pinnacle of him sharing information, and it is so well done. You're going to learn a ton. Each one of these looks like a movie. The production value and the joy of watching these, you're going to really enjoy the aesthetics while getting all of that amazing information. They have 11 categories with over 150 instructors now. And the lessons are about 10 to 15 minutes long, so they can fit into your busy schedule. And you can get unlimited access to every single masterclass. That's the big innovation here, for 15% off an annual membership. Go to masterclass.com/startups. Masterclass.com/startups for 15% off.
Jayco, welcome back to the show. I'm excited to talk to you about this bill that I think we all hope passes.
I'm excited to talk to you too. Thank you, Molly, for having me.
So now I understand you have recently been in DC. what's like the scuttlebutt? What are you hearing?
Well, there's two things going on. There's a lot of sort of surprise for sure, and then a lot of fingers that are crossed because, we haven't landed the plane yet, as they say. So there's still a bunch of work to be done. But, obviously having something to talk about rather than not is a big deal. And the size and scale and number of things that are in the bill is really pretty exciting. So I think people are really cautiously excited and optimistic about it.
Not to put you on the spot too much in terms of, reciting the contents of the bill back to us, but what are the headlines for you? Like, what are the things that you saw in there that you were, thrilled to see, a little disappointed in?
I'd say that if you wanted to unpack it, there's probably three components that are really interesting that are ways to kind of get your arms around what's going on here. The first is it's really big, like very big. $369 billion. That's like 4.5 times the size of the $80 billion stimulus that went through the Department of Energy in the last financial crisis. So if you remember back then, if you go back in the Wayback Machine to then, among the things that were funded during that time period was a $490 million loan to Tesla. And if you went back and talked to yourself at that time, you would have said, electric vehicles is so speculative, who knows what will happen. And now you think this is an inevitability and the trend line is going to be really strong. So imagine 4.5 times the amount of funding that created very different long-term trend lines now being applied at scale in this particular piece of legislation. And then beyond that, I think there's, two kind of nuanced new areas that are really interesting as a matter of focus. And then, several different components of what the federal government is doing here in terms of unlocking what I think will be a much, much longer and clearer trajectory for where these things are going.
What are those? Wait, you said that there are kind of like two other big trend lines in here.
Yeah, so this is not your father's like renewable energy bill. There is plenty of renewable energy and clean
tech. Did my father get a renewable energy bill?
Well, somebody did. But I think that the two things that are really interesting that are a bit different this time around are, one, it is very squarely focused in part on the users of the technology, on consumers and particularly disadvantaged populations in the United States. There's a very strong equity and justice component here, both in terms of getting clean technology access to poor communities and disadvantaged communities, and also getting access to these types of technologies in a way that actually just genuinely does reduce the cost of them adopting these technologies among different sets of consumers today. So it's not just a broad program. It's one that's really looking at how is the distribution of the benefit of these types of technologies going to occur. And the second piece is there is what we would describe as sort of a climate 2.0 awareness in the bill, where there is real resilience and adaptation and new categories like $20 billion for climate smart agriculture. That's a totally new category. $5 billion for forestry, $2.6 billion for coastal communities. And then woven through the rest of what's in the bill are considerations about the effects on the environment and on people of the impact that we're now unfortunately seeing continue to unfold because of climate change. So those two kind of different flavors are, I think, something that's new and novel and very important about how this bill is being put together.
Right. So it's a little more sophisticated. It's not just a blunt instrument to say, we're going to incentivize as much solar as possible, or we're going to incentivize as many, electric cars as possible. It's a slightly more targeted intervention. It sounds like of the type that is appropriate for government to do rather than maybe private industry.
Yeah, and I think the way that I think about it in part is this is almost the second half of a dialogue or a conversation between government and industry, right? So if you think about the infrastructure bill that got done last year, which is law and has components of building resilient infrastructure and communities in it. It has other components that support parts of the clean energy transition. In the space, since we've been talking about this in the last year and a half, one of the responses to the new administration, I think, has been, to date, that the count is something like $50 billion now of private equity and venture capital focused on climate, and a much broader set of commitments that were made in November in Glasgow by financial institutions, companies, global stakeholders to really thinking about the net zero transition. And then this, if it passes, represents kind of the other step back by the government saying, look, this is going to be a scaled, supported, much more long-term, much more comprehensive pathway to responding.
How important do you think it is to have these two things acting together? Because I think, when we all thought this was dead, which was not very long ago, there was, this moment of like, okay, well, it's gonna fall on us. Like, here we go. Everybody, like, try to innovate our way out of this. But that was never going to provide kind of immediate broad-based results, right? It's not our job to invest in things that are accessible and easily affordable to disadvantaged communities. It's maybe our job to invest in things that might be, and I'm generalizing here, but some things that might be expensive at first and will hopefully get cheaper over time as technology does. But that's not the only basket of solutions that's needed.
I think that's right. And I think, when you look at the tools that the government has now put in play here, they come in kind of three flavors. One is there's direct now funding and support, $2 billion for breakthrough technologies and clean technologies out of the national labs, right? But then multiple ways that they are trying to basically leverage or incentivize everyone else to adopt and accelerate the pathways that we have in various parts of the clean economy, whether it's investment tax credits, production tax credits to accelerate the adoption of products or to build more manufacturing. It sort of follows on thematically what would happen in the semiconductor industry. But then finally, the government itself as a market actor. I mean, the government buys a lot of stuff.
Right.
So $3 billion to buy zero emission postal vehicles out of $9 billion of overall allocated procurement. I mean, that's a big amount of stuff that the government itself is going to buy to pull through demand. So it's pushing on the technology side that will get picked up, I think, by innovators and entrepreneurs and investors in early stage investing, venture capital, growth capital, and so on. It's incentivizing folks in the market broadly to pick up the products and services that are being generated by that technology and entrepreneurship. And then the government itself is, moving the market because it buys stuff all the time. And if it's buying stuff that helps with the trajectory, it's at least not buying stuff that's going to slow the trajectory.
Yep, totally.
Before we get to the ad, it makes our team so happy to see our partners celebrate big wins. And I was so thrilled to hear about this huge funding round for our partner, Odoo. Really great stuff from Julian and the team, especially in this crazy venture market. It speaks a lot to the incredible product they're making. And, right now, you've got a lot of SaaS apps. Maybe you don't need all of them. Check out Odoo's suite of business apps because you're going to save money and you're going to get more done with less effort. Using Odoo means you don't have a bunch of different SaaS subscriptions weighing you down. Everything you need is already inside of Odoo. All you have to do is flip a switch and turn it on when you're ready. And they'll only charge you for the apps you're going to use. Odoo has over 40 main apps and over 16,000 apps from their open source community. We're talking about sales, accounting, marketing automation, HR, website builders, and so much more. You can have one customer support contact, all your data in one place, and all of your apps will be supported by that same customer support team, not 20 different ones. And here's the best part. Your first app is free forever, and Odoo is offering $1,000 credit on your first implementation pack. Amazingly generous, $1,000 right now. Odoo.com/twist. ODOO.com/twist.
How big a deal is this for our industry? I mean, we've seen, just like you said, $50 billion in private investment. There have been questions about whether this might be impacted by the recession. I personally am of the opinion that it's not an optional investing class, but you never know. But I wonder, how big of a tailwind is this all of a sudden?
Well, again, fingers crossed on this, but I think it is pretty.
I should say, could it be
pretty substantial? And I think I would sort of divide that impact into two major components. One is the direct effect, right? So you have this push on research and development that will then yield different types of technologies that will be commercialized in a few years. There's a direct impact from the government buying stuff right now that is going to create a more stable view of what the market opportunity really is. And then there's all these other programmatic activities that are going to incentivize industry and communities and individuals and other parts of the government really to accelerate that transition. So we had some of the initial down payment in the infrastructure area last year and capital being raised to think about how quickly this transition is going to happen, I think the direct effect is much clearer programmatic support for different parts of renewable energy, but also the creation of these new areas like agriculture, like forestry, like coastal regions, and this emphasis on really how this is going to happen. I think the indirect effect might be even larger, which is what this does is create a sense of stability and sustainability that is very different than the situation was, a month and a half ago, right?
Right.
Where you start to think, okay, well, again, take yourself back to your gut check in January 2009, like, did you think electric vehicles was an inevitability? And the answer is no. Now I think there's a much higher probability that people think that that's the case. And this really, really cements that. And the question is, what other things become really clear or really start to feel inevitable, get to that critical mass as a result of this type of spending, right? So agriculture really making a transition and focusing on the effects of climate change in the resiliency sense and the environmental impacts on people, right? The human element emerging in the bill itself. I think all of those things create, just a more clear, forecastable future in which you can make these investments and follow on. I mean, one of the things
it's a de-risking.
I think it's a stabilization of the environment and an acceleration of that environment,
Mm-hmm.
right? I mean, $369 billion is a lot of money, the question that I think we poked around in our last conversation, which is, okay, well, all this stuff goes into early stage tech investing, this last wave of capital that's been raised, or very late stage investing. What happens 2 or 3 years from now when all those early stage companies like get into junior high school? Like, who's going to fund that? And will they really, is there really a pathway for them to continue? I think this creates
awkward teenage phase. Oh,
exactly through middle school and all that shyness and at the school dance. Now I think you have a clearer view that this is going to continue to roll out for some period of time with some heft to it, and the signals that are being put into the market, the support, in the pushing of technology with the national labs, the pull through and actually buying stuff, and then all the leverage in the middle, at this scale, I think creates a very different environment in which you're going to actually move these technologies and the opportunity set forward.
We've been talking for a long time, and you sound a little more positive. Again, fingers crossed.
Fingers crossed.
We're not across the finish line yet. I don't want to get ahead of ourselves here, but
yeah, I would say I am cautiously optimistic, and I'm more optimistic certainly than I was a few weeks ago. And that is because the shape of what has emerged is a kind of evolution of where we've thought about where this could have possibly gone, right? Like, so, if we went back to the early days of discussion about where we were in the clean tech space or in climate tech, or broadly saying like where we were in the transition, I'd said before, look, there's 3 things to think about. One is prioritization. The third thing that President Biden did was, reaccede the United States to the Paris Agreement. The second thing was people, the number of people in the government and the administration that actually know how different programs work and how to make the machinery of government oriented in this direction was really gave grounds for a lot of optimism. And the third piece is the policy. Like, what are they going to do? So you got part of that last year, and now you have a much different scale of actual activity if it happens. The qualitative stuff that makes me more excited than I might have guessed I would have been, had I not seen this, is I do think that there is a genuine, money where your mouth is aspect to the resilience components, to the adaptation components, to really focusing it on populations that are really taking it on the chin, and then broadening the scope of what we think about in the transition to agriculture, to forestry, to coastal regions, to environmental impacts, and to this idea that we are going to now plan in a more serious way, not just for to start the beginning of a low carbon transition, but one that really takes account of the fact that we're going to live in a very different, more climate affected, adapted and more resilient world if we build it that way.
Right. I want to ask you about that in a minute, since of course that's what you specifically do. But before that, what do you say to the idea that that markets would have gotten this done anyway. Markets would have led us in this direction no matter what, because it is the natural way of economics to seek maximum efficiency. And that, when government comes in with these incentives, you get like perverse outcomes sometimes, or that you can have the rug pulled out, like happened in the first clean tech investing boom.
So I think I would take a little bit of issue with the premise of the question that the rug was pulled out of us in the first clean tech boom. There's certainly things that didn't work, for sure. So I'm not saying that didn't happen. But I'd also say that, the economy is not a perfectly managed machine, right? Like we have, our flashback to the 1980s. We have a Top Gun movie. There's a war with the Russians, and we have inflation, right? And then questions about, economic stability going forward, right? So it's not a, self-oiled machine in that sense. And the activity that led to the last stimulus was, the global collapse of the economy almost. And we're in a situation where, again, you have inflation issues, you have, choppiness in all kinds of parts of the economy, and there's a time for the government to intervene. The other side of it is the government does stuff all the time. Like we got to buy trucks for the postal system. So we're going to buy ones that are going to drag the economy in a particular direction or accelerate it in a different direction. Are we going to support other parts of our foreign policy or economic engagement with the rest of the world in a way that actually supports our ability to build relationships and lead on climate and build technology in the United States? Or are we going to sit back on our hands and sort of watch the rest of the world, go forward and get to it? So I think the idea that this is all going to happen at the right efficient pace and there's no other distortions in the economy, whether it's, subsidies for the fossil fuel industry or ways that we're actually buying and selling things in the government itself as an actor, I think is not entirely correct. So I would say that the difference is, the rest of the world wasn't standing still either. $50 billion was raised to deploy capital in these areas. This creates a different part of the conversation that can continue now. And even though the federal government was sort of offside during the Trump administration, in the climate context, broadly speaking, New York State and other states and municipalities were deploying utility scale solar and wind, and were really moving forward with innovation and driving a lot of activity forward. Some of that, catalyzed or facilitated at really critical points in time by the last stimulus, for example. But parts of the world were moving. What I think this does is creates momentum and stability around how that trajectory is going to go, as opposed to a lot more uncertainty about whether it's going to be 2 steps forward, 1 step back, or 2 steps back. I think this says, okay, we're really going to move in this direction in a reasonably sizable way and do it in a way that's not that's multifaceted, that's more thoughtful.
Right. I mean, it feels to me it's just an accelerant, right? Which is frankly what we need. So if everybody is now rowing in the same direction, it makes our investments seem less like outliers. It has this effect of creating a large safety net and, like you keep pointing out, a really big market. I don't see a downside, really. I mean, we need government to get in the game here.
I agree. And government to get in the game again, the small pieces, the government's like going to buy a bunch of trucks and, spend money on clean tech because it's going to buy vehicles and, runs a hospital system and runs a transportation system through the, VA system and through the Postal Service anyway. So we're doing that. So why don't we do that in a way that actually is supportive of this? But by creating incentives so that the rest of the economy does, make it more efficient and uses those incentives in a way that actually accelerates the transition. And I think, the recognition that this could be a major competitive advantage for the United States going into the next decade, because, the one thing, as we said before, that I have more certainty about than almost anything else is climate change is going to continue. And so what this says is, okay, now we're going to give you a clearer picture of what we're doing as we see that environment change and the needs of that environment change, about how government policy is going to unfold with real resourcing in support for technology, purchasing of actual activity, and then creating incentives for the rest of the economy to drive forward in this direction.
Yeah. All right. And now let's talk about adaptation and resilience. That's what you do at your firm. That's how I came to this kind of area, basically, as a journalist back in the day, which was like, how are we going to survive this? Quite literally. So what does it mean? I mean, when I started covering it, and I'm sure when you started investing in it, and throughout, it's been this kind of like unloved part of the conversation for a long time, or it was. And now there's this realization that no matter what we do, there are effects of climate change that we are not going to be able to evade anywhere in the world. And we do, in fact, have to survive them. So like, what kinds of technologies do you think are enabled? How exciting is it that this is such a big part of the bill as proposed? And then what kinds of technologies could it enable that could really do a lot of good?
So I think it is pretty exciting, really pretty exciting. And part of it is because, as I said, the two thematic differences are this orientation towards disadvantaged and impacted communities, right? Which are the people that are being impacted really dramatically by the effects of climate change right now. If you look at the heat events, the flooding events, the storm events, the impact of wildfire pollution, the people that are getting impacted today and will be disproportionately impacted are the people that are going to be the focus of a lot of the activity that's supported by this bill if it moves forward. And it's been the focus also at the state and local level and in the international context in developing countries. So I think it's great that is a clear, explicit priority, this idea of environmental justice or climate justice and equity, because that is the humanitarian piece and the equity piece of what's going on here. The second piece is, woven through the energy transition components or the clean tech components of it are now much clearer considerations about that effects piece, right? So we're not just going to deploy clean technology or renewable energy. We're going to do that and support storage. We're going to have a smarter grid approach to it that's going to deal with the fact that we might have spikes in demand for air conditioning because of heat events. We're going to think about the impact on environmental pollutants, which get much higher because of humidity or temperature increases. And so woven into the way that this is moving forward are these considerations of like a 2.0 approach to impact on climate. And then new categories. I mean, $20 billion of support for climate smart agriculture is a big deal. Support for, afforestation and trying to deal with wildfire impacts, looking at coastal community vulnerabilities in the billions of dollars range is, new activity that is really squarely facing up to the reality that we're all unfortunately facing right now, which is flooding, storms, fires, heat events, effects on human health as a result of that, the effects on the economy as a result of that. And I think, this is a big step in that direction.
Mm-hmm. Bugs. Don't forget bugs. There's going to be pestilence. Somebody years ago mentioned to me the fact that like climate change is going to come with a whole lot of insect activity that we are just not prepared for. And I was like, okay. So that was a tangent though. So where does this put us in the, on the global stage? You are, in addition to being the co-founder and MD of the Lightsmith Group, an official partner of the UN Secretary General's Aid to Our Climate Resilience Initiative. Are you feeling a little better about showing your face in that crowd? Or will you be when this passes?
When this passes, and let's have
saying when.
Yes,
we're going to manifest it.
I think absolutely this reasserts a strong U.S. leadership position in the global context, and I think the two things that are interesting about it are, one, it's not merely saying that the U.S. is really willing to put capital against this or funding or taxpayer dollars against it. It's saying we are going to be very supportive in a set of nuanced ways in transitioning multiple parts of the economy in this direction. So if you want the opportunity to innovate and to invest and to develop technologies and solutions, then the U.S. is going to be a much clearer destination for those entrepreneurs and technologists and capital, right? So, $370 billion of support, direct for technology, pull through by purchasing, and then a lot of incentives in the middle for production, for investment, for communities to look at things, means that the scale of what the U.S. is offering as a destination for these types of solutions to be created or to be applied is much clearer now, if it happens, than it was 2 months ago. And then in the broader context, I think it's very important to be able to deliver on what had been the priority piece at the beginning of the administration and the people in place. So the policy showing up, and we did some of it last year in the infrastructure bill, but really this moving forward, I think, enables the United States to assert that it's really putting its money where its mouth is.
Yeah. That's great. I like the idea that we could become a destination for the best and brightest too. Once again, let's do that. Let's go. Let's build. Why do you think this was so secret? Just from your perspective.
Well, I think that's kind of the surprise too. I don't think I certainly had no anticipation of what might have happened. I think it's a very challenging time to get a lot of different things done. It's a very complicated environment. I think there will be effects on affordability of energy access of consumers and different populations being able to adopt and be part of the energy transition without having to be impacted as much by all the other increases in inflation we're seeing in other places. So I think crafting this so it meets this moment, as opposed to we're just going to fund a lot more of clean technology and it'll be good for everybody. Don't worry. I think was probably an important part of what made this possible. And then I also think that there are some, again, nuanced and creative elements in this that took some time to think about. In the broad political landscape, things are challenging and complicated. I think when this was discussed, climate action last year as part of, Build Back Better or other strategies, and, amounts that were maybe 3 times as much as we're talking about here, or 2 times as much. It was a different set of economic conditions and uncertainty that's out there. So I can't really speak to the politics of Capitol Hill per se, but I think what you have is something that is crafted for this moment in time, right? Which is, how do we actually have this affect the average person and the populations that are most affected? How do we create an environment where it shows the leadership that the United States can have and supports the places where we have the biggest advantages, like in technology and investment in these other areas?
Do you think, last question, as this moves toward passage, that this also just becomes the kind of economic argument that can get lots of different constituents behind it? Because it clearly we see this as a big, climate is the biggest human story, but also the biggest business story on the planet. And it seems to me that the economic benefit in terms of, U.S. innovation, entrepreneurship, investment in a future where most of us make it through this, which is good for keeping our country strong. All of these benefits that are sort of fundamentally pretty mainstream. Everybody would agree that those economic benefits are strong. Does that start to create enough, do you think, pressure to keep this from being yes, I'm dancing around the issue of when are Republicans going to realize that this is actually just a good economic argument? But does it make it harder to walk away from a bill like this when it's look, it's going to lower prices. It's a great investment. It's going to push a lot of, investment in private equity money. At what point does it just get too hard to say no to?
Well, I think what's interesting about the way that those 2 thematic changes have played out in the bill is that I think it makes it more compelling and more relevant, right? So it's one thing to say, solar and wind is really important and electric vehicles are going to be great for everybody and there'll be a better investment climate and we'll have entrepreneurship and technology development and that's all great. What this is also saying is, okay, we know people are getting hurt right now by fire, by floods, by storms, living in coastal communities, living on farms. And we're going to actually direct meaningful chunks of funding towards those areas because that's part of how climate is really going to be experienced by humans, by people that actually care about these things. And that's a constituency that's beyond, technologists only focused on solar energy or wind energy. I think the other piece of it is by creating kind of a clearer pathway and momentum over kind of duration. So it's not just this year we're going to do this. It's saying, look, programmatically we're going to deploy, $369 billion over a number of years in the early stage for supporting more technology right now and buying things that actually embed this technology, and in the middle by creating these incentives. What that also tells you is that if you're, in high school and you want a good job, or if you are working in the fossil fuel industry and you're trying to figure out what happens next, or you're trying to advise your kids, like, hey, this is not something that is a questionable trajectory in the way that it was before. This is an industry shift that means good jobs can be created in these places. If we deploy a ton of offshore wind, that set of wind farms is going to have to be maintained by people going out on boats for 20, 25 years and making sure that transmission lines work and that the wind turbines are spinning, electricity is being generated. And those are great long-term commitments to communities that can provide good jobs, good employment, a pathway that isn't kind of a speculative, well, maybe that'll happen and maybe that won't, right? So, the idea that a good job in the automotive sector could be, being in the EV sector was, again, like in 2009, like, really? Maybe. And today seems a lot clearer. And I think going forward, other parts of the economy are going to look more clearly along this pathway. So I would say the human focus, right, on the people being affected right now and how that's going to happen across many different communities, agriculture, forestry, coastal communities, disadvantaged populations. And then the fact that now you've created and reinforced, as you said, the trajectory or the acceleration here means that you can really think about this as a clearer future for people to get good long-term jobs. And I think that is, always a pretty persuasive constituency supportive mechanism, is to make people think, look, this is a real future. It's not a future for a small bunch of people that would like to do something that's good for the world. It's like this is part of a real reinforced transition that's going forward.
Right. Like Joe Manchin, you could say a lot about Joe Manchin, but was on Fox News the other day saying, like, look, this is a bill for America. It's a red, white, and blue, or red, white, and blue bill. That's good for the country. And if you love the country, why wouldn't you support it? And I was like, I'm going to give you this one, just this one.
I think it's good for American entrepreneurs and technologists. I think it's good for investors that are looking to think about what happens next and where the future is going to go. But I also really think what's great is it's affirmatively good right now for a lot of the people being affected right now, and that'll be increasingly affected right now. And I think, going back to your point about the global context, you can pick, last year we were talking about, you could pick your continent to get flooded out of, right? It could be China, it could be New York, it could be, Europe, it could be anywhere. This year it's like, pick your continent to be lit on, have like fire affect your future. And unfortunately, I think those things are going to continue. But by saying, look, we are going to, create much more momentum here. It creates a pathway for industry and technology and entrepreneurship and investment, I think, here in the U.S. that, really helps all those folks. And then directly is targeting a lot of that benefit at the people that are being impacted right now, which I think is a meaningful change in the way that this is being oriented.
Jay Koh is the co-founder and managing director of the Lightsmith Group, the first private investment firm focused on climate resilience and adaptation. Thanks for coming back.
Thanks for having me, Molly. It's great to be here.
And also, let's manifest.
Yes.
Right, you're a congressperson.
Yes.
Especially if you're in Arizona. All right, everybody. Thanks for tuning in on a Sunday.
Yes, Molly is out next week. Just like I was out for a couple of days on the river, Molly's taking a little trip, and I'm sure we'll get some updates from her when she gets back. But we have a ton of great content for you next week and some surprise co-hosts coming in for what has been a ridiculously active August.
I like that. RAA. Ridiculously active August. We banked some interviews. I'll be peeking into the feed here and there. I won't be like completely absent. But yes, nothing live from me.
All right. We'll see you Monday.
Adios.